My guest today is Mario Bottone. Mario has led global organizations in various sectors over the past 20 years and is currently the Chief Marketing Officer at Thinking Capital. Thinking Capital is one of Canada's original FinTech companies and in many ways has transformed the way small businesses access capital they need to grow. The Montreal-based company has been around since 2006 and since then has helped over 16,000 small businesses with smarter access to financing. Amid the COVID-19 crisis, Thinking Capital has created an extensive resource library, including the Small Business Health Index, which gathers sales data on a daily basis from 600 merchants to illustrate the impact on the Canadian small business landscape by industry and by region. Mario joins me today to discuss the impact of COVID-19 on the small business industry as well as the lending community, new important trends that are emerging, as well as what the short and long-term economic recovery process may look like. Mario, thank you so much. And let's just dive right in. I've been following the Small Business Health Index that Thinking Capital has put together that breaks down the impact of COVID-19 on small business owners, both by industry as well as by geography. Can you just share some of the main insights that you've been able to gather so far from this health index?
We started to keep track of the potential impact of COVID early in March, but it got obviously amplified pretty dramatically over the course of the first 2 weeks. And around mid-March, we were all caught a bit off guard. And this is where we kind of took an initiative in light of the fact that we had roughly around 600 or so merchants data on a daily basis that we were tracking. We decided that at that point in time to kind of take a look at what was happening with direct sales activities. And of course, we kind of wanted to kind of look at the progress or the lack of progress, I would say, from week to week, day to day, and also benchmark it. You know, we had a situation where we had to kind of figure out what would be a good benchmark. We kind of suggested something earlier in the year on February 8th in terms of the date to have a benchmark. But we also wanted to kind of track what was happening in the short to midterm. So we wanted to have a rolling week over week type of look of the data. And hopefully at one point or another, track the recovery of the economy to a certain extent as well, right? Like some of these industries at this stage of the game have been able to make the giant leap to the next phase and are kind of conditioning themselves for COVID-19 world. Think about restaurants that offer takeout, opportunities to provide your product through an e-commerce channel. There are companies that are better adapting to this. The way the data was set up is kind of a combination, an amalgamation of all these types of companies. So by no means are we able to parse out specific strategies that certain sectors are implementing and seeing if they're less effective or more. It's anecdotal. That being said, it still was very early on. You saw dramatic declines day to day, week over week. And when everything stopped, specifically for the restaurant and bar sector, that's where it fell off the cliff. There are some that are basically adapting better than others. So it's an interesting look. You know, by no means do we have all the small business in Canada. You know, we don't have like 400,000 or 500,000, merchants reporting their daily activities here, but it's a snapshot, and it still gives, along with other information that we provide in our resource center. That's one of the first things we did. I think we did pretty quickly is we started building up something we thought was a useful repository for our small medium business that we could direct some of our customers to. But no, this is an extension of that. We're hoping that it also gives us the first lead indicators that the economy is starting to slowly but surely come back to.
I mean, I'm looking across the board, and like you said, it may not be capturing every business owner out there. It may not be capturing all the tactics and how they're actually adapting to what's happening. But when you compare them side by side, certain things definitely jump out. Like, for example, when you look at the grocery sector, they are down, but they're down only about 12% when we're looking at this particular week versus the benchmark week versus the average of minus 60%. And the sports and leisure industry had an uptick because people are now more inclined to maybe buy fitness equipment. Can you just speak about some of the outliers that you've noticed? The impact from COVID is different on them than the rest of the industries?
There's winners and losers in any crisis, right? In many ways, this particular industry emerged from the industry that we're in, emerged from the ashes of the 2008 crisis, right?
Mm-hmm.
So companies do emerge from these type of situations. What's different in this particular situation is that some of the companies have to get through the storm before they see the light of the day afterwards, right? So there's a lot of work to be done. The key to this situation is to be able to weather the storm and to be in a position of, kind of adjusting your business model to reflect this post-COVID-19 world. Because I don't think we're ever going to return entirely to a state of normalcy that we had prior to this.
Right.
It's just not going to happen. So, we have to be, as an organization, able to identify, those type of sectors that are going to be able to survive, stabilize, and then potentially thrive. And entrepreneurs across this country, those have been doing business a certain way, have to adapt. The bounce back or the rebound scenario in the economy is going to be slow and gradual. It's going to be a bit of a dance in many ways, with certain sectors of the economy opening up while others stay quarantined. And some of these merchants will reemerge, those with better models that allow them to go through the storm, and others who are going to, literally kind of reemerge from this situation as a completely different business or significantly different business, I think, probably the more accurate way of saying it. So, we look at it and we say to ourselves, okay, merchants that had, embraced an e-commerce type of approach, a platform, or had a significant digital footprint, they're well equipped to potentially weather this storm. Physical businesses such as restaurants that provide like an order and takeout option, again, they're probably down considerably in our index, which suggests that. But those who basically have a takeout option at least have a lifeline. Those businesses are best equipped to kind of see it through and stabilize over the course of the recovery, which will be fairly long. There are local construction businesses, who are going to be called upon to retrofit establishments to abide by post-COVID-19 regulations. You're starting to see it right now when you go to grocery stores. You see these glass or plastic partitions that are being put up.
Mm-hmm.
That in itself, as we look as a lender and we look at organizations that have the best opportunity for stabilization and potentially growth, those are other areas too. The other thing that I think is being underestimated here, and it's not really, I would say, was not in our sweet spot as a lender. I'm talking about thinking capital, but is something that has been emerging over the last 5 to 10 years, and is going to become more prevalent, I think, in this new world. Is the gig economy workers. They'll need to, in some instances, there are 1 or 2 people shops. Maybe they'll have to be 3, 4, 5. They'll have to make some investments, because now you can see a lot of our traditional businesses needing to acquire new skill sets, whether it is to get, an e-commerce site, additional IT, maybe some specialized marketing, digital marketing, some logistics, some physical embarkments or retrofits for their product or their stations and how they deliver their product. All those different elements now will make for smaller workers, smaller sized organizations or gig economy type workers to be potentially more solicited. And those are type of organizations that might need to invest to handle more demand for their services. And the other thing too is, in light of some of the issues with supply chain, we all experienced that initial shock of going to Costco and seeing that they were running out of toilet paper and other products. Try to find a Lysol wipe somewhere; it's impossible.
Mm-hmm.
There's going to be a greater dependency moving forward on doing something related to local supply, and manufacturers and distributors that can ensure local supply to businesses might be able to benefit from some of these changes that are occurring.
We actually did a survey
a few weeks ago, and we surveyed a couple thousand business owners that are in our database, and we just asked them about their situations. And in the very end, we also asked them to just share sort of their story, if they're comfortable, because we just wanted to see, sometimes it doesn't come through in stats what the businesses are actually experiencing. So we asked them to share some stories. And there were so many cases that I read where a business was actually set up here, and it could be in the manufacturing space, for example, or something in the construction related field, that they were actually able to work, but the problem was that they were expecting materials to come in from somewhere else. And that was literally the only sort of barrier to them actually getting through this crisis. They didn't get shut down here. They were able to stay at home. They don't have a retail store. They don't need it, but they just couldn't get the materials. They couldn't do the work.
Exactly.
Yeah.
And I think that's also going to be a major consideration in terms of how we reopen the economy, is what access you do have in terms of supply. As I mentioned earlier, there's no quick fix to this.
Yeah.
And I think the fix is really figuring it out from the health perspective, ensuring greater testing, quarantining people faster, more effectively, and letting people come back to work, socialize with less concerns about whether they're getting this thing or not. There's so many things that are emerging in terms of information right now on the health front, and I suspect in a couple months from now, we're going to know much, much more, much more testing, and that's when we'll feel a little bit more confident. But we truly are not going to get really back to the normal situation we were back in, let's say, March 1st or mid-February, until we have a vaccine, I suspect.
Right. Mario, you talked a little bit about how everybody sort of needs to adapt, and that includes the lenders as well. And we all know that access to capital is so important for small business owners and not small business owners, really anybody in Canada. So what are you currently doing with your current customers that are coming to you and calling you and saying, hey, I have a loan outstanding. This is my situation. How can you guys help me? And my second question is, post-crisis, how does a business owner think about now in terms of setting themselves up to be eligible for financing in the future and have a type of business structure and systems in place that will make them, attractive to a lender, for example, like Thinking Capital, so they will be able to access the working capital that they need in the future?
Well, the answer to your first question is, we've been finding ways to extend loans, reduce payments, accommodated some of the cash flow restrictions that our customers have. So I think we owe it to them. Our senior lenders have been very accommodating as well. So in many ways, we've been paying it forward in terms of the type of understanding that I think everybody has at this stage of the game. This is something no one could have predicted, especially small businesses who are so tight and represent such a big portion of our economy. The challenge we'll have is that what worked pre-COVID might not necessarily work post-COVID. And we're going to have to figure out, based on conditions that we think are going to prevail, have a bit of a crystal ball. We got to look at companies differently. Certainly, we want to look at businesses that were able to make it through the crisis because they had something to offer that sustained itself and are probably in the best positions to take, take this situation and just evolve and the good business owners, good business practices, a well-known presence maybe in a certain community, good customer base, you name it. And those are type of organizations that are going to, I think, continue, albeit, probably be hurt by this, but probably continue. And we want to look at them maybe in similar ways. But it is also about looking towards the future and getting a better understanding as to which of these organizations are best suited to take advantage of some of the emerging trends I mentioned earlier, right? So
yeah,
we'll be evaluating them differently. There's no question. The risk model we had before will have to be adjusted to reflect this post-COVID economy.
Do you think that in addition to just the risk model, there will also be changes to the actual product offerings? I mean, right now in the industry, some of the primary small business financing options, you have a term loan, you have a merchant cash advance, maybe a line of credit as well. Do you think that there will be sort of evolution of product offerings as well post this crisis?
That's a very good question. I think there will be adjustments made. I think the primary vehicles are going to stay similar. So there might be adjustments made accordingly to reflect some of the intricacies associated with an economy that's emerging. You know, maybe there's more risk sharing potentially in certain circumstances, more guarantees that need to be offered in some instances. But that being said, I don't think there's going to be dramatic changes. I think there's just going to be a different way of applying them, perhaps, to these organizations, and how we evaluate risk is going to change. That's for sure. You know, somebody in my entourage said the other day that you know, restaurants have been around for 4,000 years, so they'll be around after this too. They might be different. They might have to abide by certain codes and approaches, but there'll still be a need for people to get together and have a meal. We just got to figure out which ones have the best chance of not only being sustained through this process, but also thriving in a new model, a new post-COVID economy.
Mm-hmm. What do you think is the role of the FinTech online lending community as a whole? And I know Thinking Capital is one of the oldest players in the game, you know, so I've even heard somebody say that they were FinTech before FinTech kind of became a word. So yes. I would like to know, from your point of view, what is the responsibility or the role that the online FinTech small business lending community should have or has right now to help us as a country sort of get through this period?
In general, if you look at the fact that the natural reaction everywhere is to try to tap on the shoulders of the banks and say, can you help us, in front of the governments here, can you help us get the money to the right hands? Well, fintechs are uniquely positioned because we deal with these small businesses on a day in and day out basis. We're talking to them, they're calling us, and we have the mechanisms and the technology to get the money to them, you know, within a period of time that's extremely reasonable. So we're hoping that we can be a big player in all this. That being said, this is about helping Canadian small businesses, and we believe that the answer is technology. We believe the answer is processes that go between 48 and 72 hours from application through disbursement of funds. We want to make sure that we're a solution that the government could utilize and the agencies can utilize to get the monies to the right people at the right time. Is it going to happen? We're hoping. We're definitely going to be there for the recovery, but we'd like to be there during the storm as well.
And I think that's really great. And I did see the letter that you did with On Deck, and I think that common goal that we have for the entire economy to really rebound is how all the different even competitors are rallying together, and because we all have that common objective. And I think that was really, really great to see. I'm actually very proud of the way that our industry has responded so far overall, and in a very proactive way, not just even on the business lending side, but even on the consumer lending side. There's so much great information that you've shared. I want to really, really thank you for your time and for these insights.
Thank you for this. No, I think we need to be confident that, you know, the economy will get back on its feet one day. We just need to figure out, you know, who will be best suited to kind of take advantage of these new dynamics that we're going to have to face, and that's, I think, the goal of this financing community now. You know, look at the world a little bit different than we did before.
Thank you so much for your time, Mario, once again, and I hope you have a great rest of the day.